Welcome to the Deep Dive, your shortcut to being well-informed. Today, we're diving straight into DAIO's second quarter 2025 results, their financials and their strategic outlook. We've waded through the earnings call, the reports, all that stuff, really, to bring you the key takeaways, helping you understand what's actually happening with this, well, key player in semiconductor programming. So let's kick things off with the headline numbers. DAIO, they had a bit of a mixed quarter, didn't they? But the market seemed, well, pretty optimistic afterwards. What's the initial read here?
Yeah, indeed. The top line was quite strong, actually. Net sales hit $5.95 million. That beat the consensus estimate, which is around $5.33 million. So, a solid beat.
Okay.
And that's a 15.7% increase year over year. Pretty robust growth there.
That is strong revenue growth, definitely encouraging. But if we look a bit deeper, it gets, well, a bit more complex. GAAP EPS, that's generally accepted accounting principles earnings per share. It came in at a loss, right? An extra 8 cents. Missed the consensus of net zero 5 cents. And the gross margin, that slipped too, down to 49.8% from, what was it, 54.5% last year?
That's right.
So how should we read these sort of contrasting signals?
Well, it's a classic mixed bag,
Right.
But there's some pretty clear drivers underneath that the market seems to have liked. Despite that EPS miss and the margin pressure you mentioned, bookings showed some really encouraging momentum. They hit $5.8 million.
Okay, bookings up.
Yeah, a solid 26% jump quarter over quarter and up 3.6% year over year, too. So this rebound in demand plus the revenue beat, it signals maybe a potential turnaround. And the market, well, it clearly weighed that growth more heavily. Seems like optimism for what's coming next.
Okay, so there's definitely more to the story than just the headlines. Let's unpack this a bit. What were the main reasons for these results, especially that dip in the gross margin? 49.8%, that's a noticeable drop.
Right. The main thing driving that margin figure was a specific large customer order. It featured a lower margin product mix, basically automated systems, but with fewer options, so a higher concentration of just the programmers themselves. Plus, the company also had some prototyping costs. They were updating their older V0 systems to the new V1 specs.
Yeah.
And those costs, weren't tied directly to revenue they booked in Q2.
So essentially, they took on a big lower margin order and also invested in future tech at the same time. Is that about right? Sounds like a bit of a strategic trade-off.
Exactly. Yeah, I think that's the way to look at it. This margin dip isn't necessarily a red flag about core profitability. It's more like a strategic decision. It shows they're landing these large, high-volume orders, which is important for market share, even if the margin on that specific deal isn't the highest.
Right.
And it validates their newer systems. So yeah, it's a calculated move. Points more to future potential than, say, current weakness, especially when you factor in the bookings growth.
Okay. And speaking of costs, there was also mention of about $480,000 in one-time expenses. How did those hit the bottom line, and are they really just one-time?
Yeah, they frame them as strategic investments, things like bolstering their core programming platform, some needed IT infrastructure upgrades, and also costs related to leadership changes, specifically the new CFO appointment and other HR needs.
Gotcha.
And if you actually pull those one-time costs out, their adjusted EBITDA, which, strips out things like non-cash items and these one-offs to give a clearer operational picture. Adjusted EBITDA would have actually been slightly positive, about $0.04 million, instead of the reported loss of an everyday $0.44 million.
Okay. That does change the picture.
Yeah, and the one-time label suggests they aren't recurring. They're more like foundational investments for the future, meant to boost efficiency and capability down the road.
Right. Now, that bookings rebound you mentioned, $5.8 million, that sounds pretty critical, especially given the wider macro environment. What drove that?
Well, the first couple of months of Q2, April and May, they were still dealing with some of that tariff uncertainty we've seen. But things apparently picked up noticeably in June.
Okay.
And the big evidence for that was a large order from a China EV supplier. Some of those systems even shipped before the quarter ended.
Interesting.
So they finished Q2 with a decent backlog, $2.8 million, and they still have a healthy cash balance, $10 million, and importantly, no debt. It definitely signals a rebound in demand, especially from, key growth areas like EV.
And breaking down those bookings, automotive electronics were dominant, weren't they? 66% of Q2 bookings, up from 59% last year. And China EV was a big part of that. Is that concentration a strength or potentially a risk?
Well, it's probably a bit of both, honestly. It clearly highlights where DAIO is strong, right?
Yeah.
They're a leader in a sector that's expanding rapidly. That's
Right.
it. But the company seems very aware of the risk of being over-reliant on one sector. And despite that concentration in bookings, it's really important to note that their recurring revenue from consumables and services, that provided a pretty stable base. It actually made up 50%, half of their total revenue in the quarter.
Oh, wow. Okay.
So that recurring slice acts as a nice buffer against the ups and downs of capital equipment sales, even within a hot sector like auto.
All right, let's maybe shift gears a bit from the financials to the strategy side. One of the really big things from the call was this major overhaul of their core programming platform. That sounds significant. What's the goal there? And what are the risks?
Yeah, it's a huge undertaking. The long-term plan is to basically consolidate everything onto a single universal programming platform. They're targeting late 2026 or early 2027 for that.
Okay.
And this is really critical because programming tech is just getting so much more complex, especially things like UFS universal flash storage and NVMe flash memory.
Right.
Those specific technologies, they're projected to grow at something like a 14% compound annual growth rate, CAGR, through 2030. That's twice the rate of the overall semiconductor market.
Wow.
So they need a platform that can handle that. The risk, obviously, is the sheer difficulty of pulling off such a big consolidation. It's complex, but the potential reward is massive. A streamlined, future-proof system ready for whatever comes next in memory tech.
And UFS yields, particularly for UFS 4.0, that's been a notorious challenge across the industry, hasn't it? DAIO mentioned a complete reset on their Luminex platform to tackle this. What's different this time? What suggests they're actually cracking it?
That's a really crucial point. Yeah, UFS yields are tough. They basically admitted the existing Luminex platform had, significant tech gaps for this, so they decided on a pretty radical reset. They brought in John Duffy to lead engineering, and the team apparently worked like crazy for 8 weeks, focusing just on UFS 4.0.
8 weeks intensive focus, okay.
Yeah, and now they're targeting yield rates way up there, 99.8%. 99.9%, which is, standard for simpler memory types, but historically very hard for UFS.
Mm-hmm.
They also expect to get the UFS 3.1 yield issues sorted by the end of Q3 this year. So soon.
And how are they doing it? What's the concrete action?
It involves actually re-architecting parts of the platform, investing in new bench equipment for testing. And interestingly, they're even looking at potentially getting into the socketing market themselves, sort of vertical integration.
Socketing market. Tell us a bit more about that. It sounds technical.
It is a bit, yeah. But basically the socket is the physical interface where the chip connects to the programmer. It's critical for good contact. By exploring getting into that market, Data I/O could potentially improve that device contact, which directly helps yields, especially for tricky stuff like UFS.
Ah, okay. Control more of the variables.
Exactly. And it's also a big market, like $7 billion they mentioned. So it could broaden their revenue base too.
Got it. Now, that big order, the $1.4 million one from the China EV supplier, you said it shipped partly in Q2. Was that just about the money, or was it really a proof point for this UFS 4.0 yield work?
Oh, it was absolutely a critical proof point. Massively important. This order was for 10 PSV automated systems. They're big production machines. And it came from an existing customer.
Right.
And that customer specifically needed reassurance that Data I/O could actually solve these persistent UFS 4.0 yield problems they'd been having.
Yeah.
So successfully fixing those issues, that demonstrated Data I/O's capability. It positions them as a go-to partner in the EV space, which is obviously huge.
Yeah.
And fixing these yield problems,
Yeah.
it's not just about this one customer. It's expected to unlock pent-up demand globally because lots of people struggle with UFS yields.
So looking ahead, it sounds like a busy fall then. New product launches.
Oh, yeah. Very busy. They've got 6 major product events lined up between September and November. Big industry shows, in China, Germany, Productronica, they're India,
Just
Mexico.
events. Wow.
Yeah. These launches are really key for showing off their progress, especially in supporting these newer, higher density flash technologies. They expect to generate a lot of leads from these. It's a big push to show they're back on top technically.
Okay. And earlier, we touched on the automotive concentration risk. How are they tackling that diversification challenge while still building on that auto strength?
Right. Well, automotive is still definitely the core strength, but they are actively trying to diversify. They're hoping these new product launches will attract customers from other sectors, and they're rolling out new sales and marketing tactics too.
Like what?
Well, one interesting thing was deploying field service teams with iPads to do what they called milk runs and system health checks. The idea is to generate more service revenue, and they're using Salesforce Service Cloud to support that.
Okay.
So basically broaden the customer base and the revenue streams without walking away from their automotive leadership.
Makes sense. Okay, let's zoom out again for a sec. The whole semiconductor capital equipment market. It faces its own macro headwinds, right? Tariffs, trade issues. How's that impacting Data I/O specifically, and what are they doing about it?
Yeah, they're definitely still grappling with that uncertainty. Tariffs and trade friction, it's hit capital equipment spending, particularly, they said, in Europe and the Americas. And it really hammered a key representative they have in South Korea. Apparently, zero revenue came from that region in the first half of 2025 because of it.
Ouch. Zero revenue.
Yeah. So to mitigate, they've been continuously shifting where they source components and where they manufacture products, trying to reduce that tariff exposure.
Right.
And crucially, again, that stable base of recurring revenue from consumables and services, that acts as a really important buffer against these big swings in capital equipment sales.
Okay. So given all that context, the strategy, the challenges, the macro stuff, what's management's outlook for the second half of this year, 2025? Do they expect things to pick up?
They do, yeah. They're anticipating a stronger second half. They expect an improving product mix, which helps margins, and generally accelerated commercial momentum.
And the catalysts for that?
Key things are fulfilling that big China EV order we talked about. The impact, hopefully, from those 6 big product launches this fall, and also just better absorption of costs as some of these strategic investments start to, normalize or pay off.
Okay. And one more thing on the operational side, the new CFO, Charles de Bona. What's the significance there?
Right. He was officially appointed effective August 11th. There's going to be a little bit of double spending for a short period because the interim CFO is staying on for a bit to ensure a smooth handover.
Okay.
But the expectation is that this appointment will help sharpen their financial systems, their operating cadence, just bring more focus. And related to efficiency, they also projected about $512,000 in annual IT spending cuts. About half of that's already done, the rest by year end.
Right. Part of that strategic investment paying off, maybe?
Exactly. It all ties together: new leadership, better systems, cost focus.
So putting it all together, what really stands out to you from this quarter and the call? For listeners thinking about Data I/O, what's the critical takeaway?
What's really fascinating, I think, is just how comprehensive this strategic shift is. Yeah, there were immediate margin pressures from that specific product mix. And yes, there were one-time investment costs. But underneath that, management is clearly executing a very deliberate plan. They're tackling fundamental, hard technology problems like the UFS yields. And at the same time, they're pushing for market diversification and better cost efficiency. The fact that the market reacted positively, even with the EPS miss, that suggests investors have some confidence in this strategic direction. They see the potential for that second half acceleration. It feels like a bet on their ability to really own this specialized, technically demanding niche.
Yeah, and connecting that to the bigger picture, it does seem like they're positioning themselves for that UFS and NVMe memory boom, right? Which ties into AI, edge computing, all those broader trends. So I guess the big question for listeners is, can they pull it off? Can this renewed focus on being the absolute experts in this niche, plus the diversification efforts, let them consistently outperform the often volatile semiconductor equipment market? That's the key question, isn't it?
Absolutely. That's the bet management is making and seemingly what the market is tentatively buying into.
Okay. And now let's pivot to our segment where we toss out a bold, maybe insightful trade idea. This is not financial advice.
All right. So given Data I/O's really intense focus, now validated focus, on nailing those UFS 4.0 yield issues.
Yeah.
You saw the proof with that big China EV order, plus that projected 14% CAGR for UFS memory. So there's an outrageous but plausible trade idea. Maybe initiate a long position in Data I/O stock itself. But couple it with selling some out-of-the-money call options that expire shortly after that big Productronica show in November.
Okay, long stock, short calls. What's the thinking?
Well, the thesis is successful product launches this fall, plus continued strong bookings because they've solved the UFS yield problem that drives the stock up into year-end. That's the long part. The short calls, they act as a kind of calculated hedge. You collect the premium, and it protects a bit if the market gets maybe too excited too quickly after the show's a sort of unsustainable spike.
Right.
It lets you capture some upside, but keeps you grounded, allowing the longer-term story, the unified platform goal to play out. The outrageous part is betting they can truly conquer this notoriously difficult yield problem and timing it around specific trade show catalysts, all while those macro headwinds are still swirling.
Yeah.
But the plausible part is the size of the market opportunity they're going after, and the fact they've laid out a pretty clear execution plan, which seems to be getting traction.
Interesting. A lot to think about there. Okay, that was a pretty thorough deep dive into Data I/O's Q2. The story seems to be one of, well, strategic recalibration, definitely significant investment, a renewed focus on the product roadmap, especially UFS and NVMe, and really trying to tackle those past challenges head on.
Indeed. Yeah, the next few months are going to be really telling. Those product launches, fulfilling that big EV order, getting the new CFO fully integrated. It'll all be key indicators of whether they can turn these strategic moves into sustained financial improvement and, importantly, that market diversification they're aiming for. It really feels like a pivotal moment.
Absolutely. And just a reminder, everyone, the information we've discussed here today is purely for informational purposes. It should definitely not be taken as investment advice. Always do your own thorough research and maybe consult with a qualified financial professional before making any decisions.
Yeah, definitely dig deeper into these trends yourself. Think about how Data I/O's moves might ripple through the semiconductor programming world and ultimately how it fits into your own view of the market.
Well said. Thank you for joining us on this deep dive into Data I/O's Q2 2025 earnings call. We hope this gave you a clearer, more insightful picture of their journey and what to keep an eye on next.